Let's get some insights on the news that's shaping markets. For that, we want to welcome in Mike Horwath, Chief Investment Officer of Diversified LLC. Mike, thank you so much for joining us today. Let's start out with your broad take on the market action. We are continuing higher. Had hit some speed bumps, but it seems like the momentum is on the side of bulls. You've got both upbeat earnings overall, and you have some strong economic data. Does where the market stands now make sense to you?
Hi, Dan. Thanks for having me. I do. I think the conversation we've had with our clients and investors in general has been this difference in hard versus soft data. The fundamentals on the hard side remain really, really strong. The soft data, all those surveys, the Michigan survey have been kind of weak, right? And they've since bounced back, but we've always said, these two things are going to converge. And the question is, which direction are they going to converge? And it looks like the fundamentals are going to win. The hard data, or at least in the short term here, is continuing to win, where both the consumer and corporate fundamentals remain really strong. And it's hard to see, too much market weakness given that backdrop.
Yeah, no, you make a great point, because look, that retail sales number coming in much better than expected. I didn't expect that on a monthly basis, especially. Like, you expect to see some momentum in July because you have all these sales, kind of Black Friday in July. But June, it just shows that the consumer is still holding up, and as long as they've got a job, they're solid. Now, you're got a modest overweight to U.S. large cap stocks, especially areas like semiconductors and dividend players. What makes those areas still compelling to you?
Yeah, I think, keeping on both sides of the semiconductor space, you guys just talked about, TSMC. I think that entire space, and as you kind of broaden that out, TSM and NVIDIA, the chip designers obviously get a lot of the conversation, but there's so many other names underneath the hood, right? The ASMLs, have had some weakness, but just the strength within there, or even the energy conversation, the complex around grid and the energy infrastructure that's needed. There's a lot of interesting conversations around the semiconductor chips and the energy complex that need to really play out over the course of time. So that really excites us. On the dividend side, the really conversation for us is just remaining high quality, dividend growers, right? We're not really overly focused on just reaching for yield, but, these companies that are seeing free cash flow, financials and tech, really strong free cash flow, paying out some dividends while they continue to grow and reinvest. We just really find that attractive at a time where, things do get a little bit of pricey, things aren't cheap, but, both sides of that conversation to us are pretty attractive moving forward.
How are you looking at international equities now? They've been an outperformer. The S&P 500 is starting to play catch up. Where do you see that in portfolio allocation now?
Yeah, it's interesting. So many people for a decade really struggled with even owning international from a diversification perspective. And all of a sudden this year, you see this reversal where, most of it's driven off of, the US dollar has weakened. That's been well documented this year. And then there's also this valuation difference where both developed and emerging in the international space, we're trading and have traded much cheaper than here in the US. And during times of uncertainty in the US, you're going to see that valuation kind of compress, but we're going to still follow the earnings. The earnings growth here in the U.S. just is so much more attractive to us than international. And it's not that there aren't interesting names, that there's not a potential for diversification, both in developed and emerging markets. But I think we're going to be a little bit modest relative to 35, 40% weighting in something like the MSCI ACWI index, as an example. We're going to be underweight that. We're going to be looking probably closer to that 15, 20% range, to capture international.
Okay, let me ask you this. I want to get your views on, I know you're on Policy Watch, and you point out what's in play is obviously the Federal Reserve. They have been in this holding pattern, as you mentioned in your notes, right? But there's been pressure from the White House to cut rates, and there's been pressure as it relates to the Fed chair's job, essentially. But, there's been pullback on that threat. Where do you think that leaves the Fed and your expectations for the path for rate cuts this year?
Yeah, I think the Fed, everyone wants to focus on Chair Powell, but there's, several other voting members that have say, and you really see some, different opinions on the path of rates as they look forward. I think they're going to hold steady until they kind of feel like they have to make a move. And the reason why is kind of some of this fundamental data remains strong. So if the labor market remains strong, consumer spending strong, economic growth right now, the Atlanta Fed projections looking in the mid to high twos for Q2. if the economic data remains strong and they don't have to cut, I think they're going to continue to hold steady while acknowledging that rate cuts are on the table if some of that weakness happens. Big reason why is and they've reiterated, is this the tariff conversation could be a short-term blip on the inflation front. They don't want to make a policy mistake by cutting rates and then having to revisit potentially increasing rates. Not that I think that that's short-term on the table, but I think they're going to remain in a holding pattern. I still think you maybe look at 1-2 cuts this year, but if they don't have to cut, I don't think they want to here in the next couple of meetings.
Let me ask you this question. I want to go to, how you approach portfolio allocation. You talk about spring cleaning portfolios. What does that mean and how does that apply in this current environment?
Yeah, I think, we saw Q1, Q2, how much, volatility there was. I think it was the quickest recovery in terms of trading days. I think it was 55 trading days for the S&P 500 to recover over a 15% drop. It was nearly 20% if you count intraday, 55 trading days. So it was a quick, recovery. And you go back to 2020, 2022, I think there's been this instant gratification of markets pulling back and recovering very quickly. I think something like a 2008 has been lost, and it's not that we expect anything remotely close to that at this point. But our conversation on spring cleaning is it's never too late to revisit asset allocation, your expectations moving forward, rebalancing your portfolio, revisiting your financial plan. So all of those things are on the table. They should be an annual checklist, just like spring cleaning is for your portfolio. That if something like Q1, Q2 happens where you have that quick drop in markets, that you're prepared. You're both mentally, behaviorally prepared. You have that long-term perspective and outlook. And there's no irrational decisions to abandon a strategy here in the short term.
Okay. All right, Mike, thank you so much for your perspective today. We really appreciate your insight and, just more perspective on your approach, especially when it comes to spring cleaning or annually revisiting your portfolio allocations. Of course, that's Mike Horwath, Chief Investment Officer of Diversified. Our thanks.